The word recession is as scary as war because it drives down the economy of a country and affects the lives of billions of people around the world. A global recession includes more or less coordinated recessions across many nationwide economies. Now you might be thinking, what is a recession? What are the causes of an economic recession and how does it impact the people? Let me tell you that trade relations and worldwide finance systems spread economic tremors and the effects of recession from one country to another. The last worldwide recession occurred in the late 2000s. Many countries of the world faced the worst financial crisis during that time. Now, after many years, experts are again predicting a great recession, and we all know that the American economy has already seen a downturn in the first quarter of this year. Hello guys, welcome back to Money Invests, where we discuss everything about how to make money, investment, and personal finance. In this video, I'm going to talk about the recession, its causes, and its impact on businesses and your lives. I will also tell you the causes and impact of an economic recession and how to save your financial well-being. So make sure not to skip and watch this video until the end. Let's start by changing the color of the like button by smashing it. What is a recession? There is no generally accepted definition of a recession. For the understanding of people, a recession is a macroeconomic term that means a massive decline in the economic activity or gross domestic product, GDP, of a country for more than 6 months. It means that the country will face a decline in the value of each good produced in the country. The term recession is different from stagnation, in which an economy either hardly grows or remains the same size, whereas the economy of a country in recession shrinks. If you also want to know the difference between a recession and depression, then in the case of a recession, the economy of the country declines for several months. However, depression is a more severe decline that lasts for many years. The global economy has experienced almost 14 global recessions since 1870. However, from 1960 to 2007, 21 developed countries had to face almost 122 recessions, but those economies were really in recession for almost 10% of the time. Each recession is unique, so there are varied consequences. Recession predictors and indicators. There is no single way to forecast how and when the recession will start. Apart from 2 successive quarters of GDP drops, economies assess numerous metrics to determine whether a recession is forthcoming or already taking place. As per the search of experts, there are a few predictors that, when they happen together, there might be a possibility of a recession. First, are leading indicators historically shown vicissitudes in their tendencies and growing rates before consistent changes in macroeconomic trends? These involve the ISM Purchasing Managers Index, Leading Economic Index, employment data, confidence indexes, and yield curve. These predictors or indicators have much importance for business and industries because they can see the warning signals and make their decisions accordingly. Second are officially published data series from many government institutes that signify the key sector of the economy, such as housing stat and capital goods. Vicissitudes in these data may somewhat lead or more concurrently with the start of a recession. The main reason is that they are used to calculate the components of gross domestic product, so they will eventually be used to describe when a recession occurs. Predicting a recession is a full game. Giving attention to these indicators can help in the preparation, but the problem is that there is never a clear-cut signal. However, a clear-cut signal to your financial success is by subscribing to the channel and dropping a like. So I ask you, did you do your duty by subscribing and dropping a like? If yes, well, you're destined for greatness. If you haven't, you still have a chance, and you know what to do. With that said, let's move on to the million-dollar question: what causes a recession? The question has long been the subject of heated debate among economists. Actually, there are countless variables that contribute to an economy's health, which makes it very difficult to pinpoint particular causes. The significant economic theories of recession focus on financial, economic, and psychological factors that can lead to an economic catastrophe and ultimately a recession. Also, the difference in supply and demand can add fuel to the fire in the economy of the country. Financial factors. The extra extension of credit and debt on perilous loans and marginal debtors can result in a massive buildup of risk in the financial sector. The increase in the money supply and credit in the economy by the Federal Reserve and the banking institutions can make the situation extreme. The repressed interest rates during the boom times can lead to a recession, and it can hurt the relationship between the businesses and customers. It usually occurs by making business plans, investments, and customers' decisions that are interest subtle, like the plan to buy a nice house or initiation of a risky long-term business expansion. Seems to be very tempting than they should be. When the interest rate goes high, the failure of these decisions can lead to the failure of business activities on a large scale, which can lead to a recession. Economic factor. Some experts explain recession exclusively due to the fundamental economic tremors such as disturbance in supply chains and the harm they can cause to most businesses in the country. Tremors that influence major industries such as energy, manufacturing, and transportation can have such widespread impacts that can hurt the economies of many countries and can also lead to the cancellation of investment and hiring plans that can affect the lives of worker consumers and the stock market. If there are not enough resources to support the businesses in lowering the cost of production and promoting investment, then this can affect the economic activities on a larger scale, which can lead to depression. There is another cause of the recession occurs when there is a negative disruption to the balance between supply and demand. There is actually a mismatch between how many products people want to consume and how many products or services that manufacturers are offering, and also the price of those goods or services, which prompts an economic downturn. At the beginning of 2020, the NBER announced, as per their data, that the United States was in a recession due to the economic tremors due to the COVID-19 pandemic that adversely affected the worldwide and nationwide supply chains, and straight harm to the industries as well. However, the pandemic-related recession ended within only 2 months, but it has left many side effects that are still bothering many Americans. Psychological factors. Many economists consider that psychological factors play a major role in bringing the recession. The extreme enthusiasm of investors during the boom times put the economy at a peak. The reciprocal doom and gloom cynicism that sets in aftermarket crisis at least intensifies the effect of real economic and financial factors as main swings. What are the impact of recession? Recessions typically last from 6 to 12 months, and the economy of the country faces a downturn of around 2%. However, in some severe cases, this downturn can reach 5%. Many businesses and companies struggle to survive, and ultimately they have to shut down the activities. As a result, many people lose their employment, and they end up having no money in their pockets to cover their monthly expenses like groceries, electricity, bills, rent, or mortgage. When the business faces a sharp decline in their revenues, they immediately cut back on hiring new employees, which increases the unemployment ratio. The unemployment ratio has a direct relation to the crime ratio. When one increases, the other also increases, and vice versa. Normally, an unemployment ratio of nearly 6% of the total workforce is considered challenging. The unemployed statistics may underestimate the real level of unemployment. For instance, in a recession time, the self-employed people may see an intense and considerable fall in their income, but still it's not classified as an unemployed. The recession has another impact on businesses that it tightens the credit condition for businesses. At the beginning of the recession, the criteria for the loaning in the market tends to be harder, and moneylenders are more selective of the dangers they are willing to take on at any interest rate. A recession also decreases the company's debtors. Many account receivables will make the payment slower or later, and many become bad debts as well. With the reduced income of the company, the affected company will be forced to pay its bills later or in tiny installments than its actual credit agreement requirement. Also, making late payments will decline the valuation of a corporation's debt, bonds, and eligibility to obtain more loans. When the declining revenue of a company shows up in the quarterly earnings report, the stock price of a company will also fall, and most investors will lose interest in the business. It's time to show off. In your opinion, what is the most important factor of a recession? There's no wrong or right answer here. Is it the finance factors, psychological factors, the X Factor TV show, or other factors? Share your answer in the comments section below, and while you're here, remember sharing is caring.